A lot of self-employed buyers typically will think that buying a home is impossible, when in reality, they just haven't been given the correct options. When buying a house and you're self-employed, it's not always a one-size-fits-all. Generally, you need a lender who understands a lot of the other programs that are afforded to self-employed buyers. And then also just being in the Dallas market, there's a lot of luxury here, which you can't buy with FHA loans, or you need a special type of loan if the house is over a certain amount. I'm Alvin with the Alvin Jr. Real Estate Group. I have my guy Lance Wilmore here, and we're gonna dive into the different type of special loans today. Lance, what do you see self-employed buyers struggle with the most?
Man, qualifying as far as their income is concerned.
Okay.
Many self-employed people make a lot of deductions on their taxes, lots of write-offs. And so when they show me their tax returns, it may show little, no, or even a negative number when it comes to the income. So that's one of the biggest challenges that people have. So if they bring that tax return to a bank and try to prove their income, most banks are going to look at that and say, well, unfortunately, because your tax return shows zero or very little income, we're not able to approve you. This is where choosing the right lender works in your favor, right? And so when you're going to a real estate agent for shopping for a home, that real estate agent needs to be connected to the right lender. They go to the big banks tell them, no, we can't do it because your income doesn't show a high enough number on your tax return. They come to me and we're able to get them closed in the next 30 days or so. The difference, Al, is the type of loan program that exists out there. There are loans that are tailored to self-employed individuals. Those loans typically allow us to not even worry about the tax returns, and we just look at their bank statements and determine their income based on their bank statements. And there's always a huge difference, right? You as a business owner, you may have a few $100,000 throughout the year in deposits, but when it comes time to do that tax return, you're finding every write-off and you're trying to make sure that you don't have to pay a very large tax bill at the end of the year. So what we do is we look at your bank statement and determine your income, as opposed to looking at your tax return to determine your income. And of course, looking at that bank statement, we see a brighter picture, when we're trying to determine income at that point.
So what are some of the pros and cons of using the bank statement program?
Yeah, great question. So when it comes down to the pros of using the bank statement program, it's the ability to get approved, right? That's one of the biggest pros. The cons, I would say, on the other side, usually there's a slightly larger down payment due, depending on your credit score. There are some more stringent credit score requirements because it's a little bit more of a riskier loan for the investor. So they want to see a little bit more certainty with your credit score. Typically, they want you to be over a 660 or higher. Doesn't necessarily mean you have to be there, but if you're not, you may require a much larger down payment. Right? Another thing on bank statement loans is usually the minimum down payment on a bank statement loan is 10%, whereas if you were able to use your tax returns, you may be able to go as low as 3.5% down for using your tax returns compared to your bank statements. So higher down payment, higher credit score requirements are two of the main factors that are differences from conventional loans.
So, for a person to get around having to use a bank statement loan, I would think that it would be smart for a person to have a professional to do their taxes and work with you. Would you work directly with people who have CPAs and things like that to see how taxes and things should be taken care of if a person has a plan on buying a home, a self-employed person has a plan on buying a home in the next year or two?
Absolutely, Al. So this is the difference between just being a transactional loan officer and a mortgage planner, right? Okay. So if a self-employed person comes to me and they say, hey, Lance, next year I'm thinking about buying a house, the first thing I want to do is meet their financial team. And if they don't have one, introduce them to a financial team. Again, those most important professionals are going to be the CPA. If they're not a CPA, that's fine. They can even be an EA, which is an enrolled agent, not just TurboTax or H&R Block. I want them to have a true professional in their corner when it comes to planning out their income and how their taxes are going to be. I also want to meet their financial advisor. If they don't have one, I need to introduce them to a financial advisor. I also want to meet their estate planning attorney because, again, having that estate planning attorney is a critical part of your wealth building journey, right? But to go back to answering your question, yes, if they come to me a year in advance, which is always good, as opposed to, hey, I need to buy a house next month and their taxes aren't where they need to be, having that year in advance plan is critical for a self-employed person. Self-employed people many times need to be a little bit more careful than just a W-2 earner when it comes to planning out large purchases. And obviously buying a house is one of the largest purchases a person will ever make. So having that conversation as early as possible is going to be important. But going from there and meeting their CPA or enrolled agent to plan out what their income needs to look like by the end of the year is extremely helpful, because at that time, that person can go into the buying decision understanding that, yes, I may have a tax bill at the end of the year. Many people write off things so that they don't have a tax bill, or it's a very small tax bill. However, sometimes you have to kind of eat crow a little bit and understand that going into this, you may have to pay some taxes. However, the reward is that you're going to buy a house at the end of it, right?
Some of the things that people write off could be added back on as income, though.
Yeah, so some of those things, when it comes to depreciation and other things on real estate and other things that they may have, you could potentially add those things back. Usually those add backs are not significant enough to make the difference. I mean, unless their income is at a marginal space. However, things that can't be written off, you may not write those things off as you're going into the plan for buying a house in the next year.
Okay. So I want to switch gears a little bit. I feel like they're still not your traditional loans, but we're in a pretty big market, right?
Yeah.
And we're starting to see more and more luxury built around the Dallas Metroplex.
Yeah.
What does the luxury loan process look like? Because I know FHA have loan limit guidelines.
Mm-hmm.
What does a person who's wanting to buy a $2 million house, what does that look like?
Believe it or not, Al, it's not much different.
Okay.
So luxury is subjective, I've found too. Mm-hmm. Sometimes I'll talk to a real estate agent and they'll say, I'm in the luxury market. I say, okay, what's the most expensive house you've sold? Oh, $1 million. Now in Dallas, that's not necessarily luxury in Dallas, right? There are literally houses in Dallas that are $20 million, $40 million, $50 million houses easy in Dallas. That's a whole different beast in itself, right? But a $2 million house is not much different from buying a $500,000 house, believe it or not.
Okay.
Now, the down payment requirement may be a little bit different. You may not be able to put 5% down on a $2 million house. You may need to put down 20% on a $2 million house. But when it comes to the debt to income ratio, when it comes to the, qualifying what documents you might need, things like that, it's not much different. That's one of the differences too, Al, with working with a mortgage broker. Now, If you go to a big bank, again, we won't name those big banks, but if you go to a big bank, they may have a lot of red tape when you're over a certain loan amount.
Okay.
However, with mortgage brokers, we don't really have a lot of that red tape. We look at that almost just as somebody buying a $400,000 house or a $500,000 house. Primary difference being there may be a 20% down payment requirement. Now, what banks like to see is reserves. Reserves are the amount of money that you have left after you've made your down payment, after your closing costs are paid, you have some money left. Usually, some banks want to see you have 6 months of reserves. Some banks may want to see you have 2 months of reserves. But I've closed multiple $1 million+ homes where there were no reserves required. Now, I would still consult with the client and encourage them to have money, but it's not always necessary. Luxury, really in the broker space, gets to be over when the loan itself, not necessarily the price of the house, but the loan is over $5 million.
Okay.
Once the loan is over $5 million, you may run into some different requirements in that case. But again, anything under that, not much different from just buying an everyday house.
So give me a quick definition on what a jumbo loan is.
Yeah.
And the difference between a regular conventional loan and a jumbo loan.
Yeah. So I think the term jumbo has a lot of stigma around it these days, but I've been in this business long enough, Al. I remember when jumbo loans were $417,000, right?
Okay.
But now jumbo loans are about $836,000. So anytime the loan itself, not the price of the house, because those are two different things, right? If you're buying an $836,000 house, but you're putting down 5% or 10%, that is not a jumbo loan, because again, the resulting loan amount is under that. Mm-hmm. But if you're buying a house where the resulting loan amount is $836 or higher, at that point, that becomes a jumbo loan. The jumbo loan limits generally increase year over year to keep up with inflation and all of the earnings and all those other things. But with that being said, when you get into the jumbo loan space, just like we were talking about a $2 million house or what have you, it's not much different for brokers. The difference primarily is the minimum down payment. So you may not be able to put 5% down when the resulting loan amount is a jumbo loan. But as brokers, we have significant flexibility. We, in some cases, can do as low as 10% down when it's a jumbo loan with no issues. Whereas banks may require you to do 20 or 25% down when you're buying a house and the resulting loan amount is a jumbo loan. But there are some very special programs out there. For example, I work with a lot of physicians. As you know, Dallas is a hub for hospitals, clinics. There are tons of medical professionals, specifically physicians in Dallas-Fort Worth. And we have physicians loans that allow you to purchase a home with no money down, even with great credit. Of course, you want your credit score to be around 700 plus as a physician, but we don't have to count student loan debt against that person, and they can still buy a house, which would be technically a jumbo loan, up to about $2 million with no down payment. Now, obviously, that's a special circumstance for physicians that exists out there, but this is another example of why working with mortgage brokers many times is much better than working with banks.
What are DSCR loans?
Man, that's one of my favorite loans. So just to kind of explain the term DSCR, it stands for Debt Service Coverage Ratio.
Okay.
And to put it plainly, it basically means, can the rent that you're collecting on this property cover the mortgage, the taxes, and the homeowner's insurance? So if it can be covered in, in most cases, then yes, you can do a DSCR loan. And even if the rent doesn't fully cover the property taxes, the mortgage, and everything else, experienced investors can still get a DSCR loan. Now, DSCR loans are not for people who want to buy the house to live in it. DSCR loans are for people who want to invest in real estate. So it's one of the greatest tools out there. And the main difference with that tool is you don't have to prove your income. So when you hear someone say, I bought a house without my W-2s, without my tax returns, you're wondering, well, how can that be done? Well, the lender looks at the rent as the income, as opposed to your earnings as a self-employed person or a W-2 employee. We're looking at, can the rent cover the mortgage, the taxes, the homeowner's insurance, and if there's an HOA or anything else, other expenses that exist for the monthly on that house.
Wait a minute. So you're telling me if I wanted to get a DSCR loan to purchase a investment property, they're not going to necessarily look at my personal income from my business, but am I getting the house cheap enough to cover the loan payment?
That's it. Yeah. So we're not even going to look at your income. And DSCR loans do require, in many cases, about 20% down.
Okay.
In some cases, you can go even lower, 15%. That's usually reserved for experienced investors. A lender will determine if you have experience as an investor by looking at, have you bought and sold properties in the past, or do you own any investment properties at this time? And investment experience is important in many cases with DSCR loans, but you can absolutely be a first-time investor with a DSCR loan.
So when we talk about experience with the DSCR loans, is a fix and flip investor, is that experience counted towards somebody trying to buy and hold investment property?
Absolutely, that is experience. You have experience as an investor in that case. Yes.
Absolutely. That sounds good. That sounds good. Well, I think that these are all very important things, especially this DSCR thing, because man, I believe I'm in real estate because I believe in real estate, and I believe that you build generational wealth by purchasing real estate. And there, of course, are some other vehicles to help families build generational wealth. But real estate is one of the best vehicles that gets people to generational wealth. And I think that DSCR loan makes it a lot easier for people to get in the game versus sitting on the sideline and, having all of these other obstacles.
Absolutely. And one of the great things about DSCR loans also, Al, is that you can put the deed and title in your business name. I have people who buy DSCR and it doesn't even show up on their credit report. Right now, obviously you still want to make sure you make your payments. It can be reported as a foreclosure if you default on that mortgage, but that's again one of the big benefits of DSCR is it doesn't show up on your credit report. You can put the house in your LLC's name as well. So you hear a lot of these real estate gurus online and they talk about, well, just buy a house with your LLC. Oftentimes they're using DSCR loans to do that.
Yeah, man. So I think for the average person, we hear about FHA, we hear about conventional loans, we hear about VA loans, but again, those things don't fit everybody in every situation. So covering the jumbo loans, the DSCR loans, and loans for self-employed people, I think that's really great information, because most people want to become homeowners, but if you're self-employed and you don't have your taxes and things like that together, you need an experienced agent who knows an experienced lender who can help get you across the line. And then for people like myself who want to build their family legacy through real estate, we've been educated on the DSCR loan. So I appreciate that. And guys, again, the resources are available to us out here who want to invest in real estate. And for those of us who are self-employed, who want to become homeowners, don't be discouraged and don't count yourself out, but information is key. And we've just given you some good information. Again, I'm Alvin with the Alvin Jr. Real Estate Group, and this is my guy Lance Wilmore right here. Y'all have a good one.